Hello everybody and welcome to my finance and accounting education channel here on YouTube. My name is Alex Petrescu. We go further today with my mini series about the basics of personal finance. We have spoken already about so many things in the episode before this one. We have spoken about how to build a personal budget with the help of Excel and of your bank statement. We have then spoken about how to get rid of debt, moving from debt to wealth. Then we went further and we have talked about how to invest for beginners, let's say, because this is the key of moving from debt to wealth. How to invest $1,000 or euros, how to invest $10,000 of euros, so basically ramping up the stakes a little bit. Then we talked about how to evaluate an investment. And then we started with talking about specific classes of assets which you can use for investing and for building your wealth. We talked first about how to invest in mutual funds or in investment funds. We skipped the part with the bank deposits and with the bonds. They are a little bit boring and not that difficult to understand. And then with the next episode we started already using the Excel template which we have introduced when we talked about how to evaluate an investment, and we used this template in order to evaluate an investment in stocks, so in shares market. Before this episode we talked about how to invest in life insurance with cash value, so basically covering for several potential risks in your life, but also receiving at the end of the policy duration, so at the end of the life of your policy, receiving a lump sum, which can be considered as an investment byproduct of your life insurance. And of course, today we go further with stay in the area of life insurance, but we talk about the unit-linked life insurance, which somehow is shifting compared with the life insurance with cash value, is shifting the weight from protection against risk, which was very important last time. That is becoming now less relevant, and the importance is now put on the investment component. Saying here this is an investment plan with benefits. Last time I said that is investment with benefits. Actually, when we talk about life insurance with cash value, it's benefits, which is the coverage against risk with associated investments, so it's a totally different thing. But moving forward, the idea is not to give up on returns and still get some protection with this policy, and I will tell you exactly what kind of protection you are still getting. Just as I have said, such a policy which is related to this unit-linked investment, it's shifting the weight from risks to investment. The link refers to the fact that your money will get into an investment fund. Usually the insurance companies, so there are several insurance companies, of course, and each of them has many investment funds which they administer. They can be in different currencies, they can have different risk profiles, so with low risk, medium and high risk. The risk levels, of course, are based on what kind of asset or classes of assets they have in their portfolio. They can have a lot of money market instruments like deposits and bonds. Bonds also, it depends if they only get state bonds, AAA bonds, or bonds which are of lower rating, if they are short-term bonds, very long-term bonds and things like this. But they can also invest in shares, and the more they get into the shares direction, the more riskier they are, but also the potential rewards are increasing, and you are getting a small protection element, let's say, or risk coverage. In this case you also have this life insurance, so if something bad happens to you, you will get, or actually not you, the beneficiary of your policy will get some money. And in my case I also have one policy which is covering for my inability to pay this monthly, quarterly actually installments in case I suffer an accident and I can no longer work. So the benefits are quite clearly defined, and also what I have probably forgotten to tell you about the life insurance plan with cash value, and it's valid also for this one, is that you need to check with your local insurance companies. Just because I have some conditions, some type of insurances, there are so many possible ways of doing this, and you need to check exactly what they are offering, and do not assume that what I got you will also get as conditions. So based on your local, so I don't know from which country you are exactly, you might have plans, insurance plans that are completely different than my insurance plan. And we jump right into the technical details. We have actually 2 slides for technical details. It's also recommended to stay on a long term. You usually don't have a fixed term like for the one with the cash value. There I've said that you can have it for 20, 25, 30 years of your choosing. This one doesn't have a fixed term. Basically it's on unlimited time. You stay inside as much as you want. However, there is a trick. You should try to get out of it when the markets are at their highest, or at peaks, and not when they are depressed. For example, if you would have gotten out of your unit-linked insurance, let's say in 2008, 2010 during the financial crisis, or you have you intended to get out when you were in Europe, for example, in 2016 during the Brexit crisis in June, if I remember correctly, or even now with the COVID pandemic in March 2020, and I think this affected the entire world, this wouldn't have been a very good idea. So to get out from your unit-linked insurance, because the markets were so depressed, and you would have gotten the least possible money for your investment. You need to pay regular installments, just as I have said. Mine is on quarters. Probably there are others with monthly. With yearly, probably not, because it's not often enough. What I also have is that I have this installments indexation. If you remember, for the one with cash value, I had around 3, so almost 3% yearly indexation, because it's more let's say conservative, more inflation related, so not that high. For this one I got even higher rates of 6-7% up to 9%. We will see in just a second. Why? Because also the policies delivering returns which are above the inflation rate. So somehow when they are indexing your premium, so each year, so after 4 quarters they are indexing your premium, somehow that you are nominally paying the growth, so taking into consideration the growth from the previous period, so that nominal in real terms you are investing the same amount of money. The idea is that since it's working as an investment plan with regular quarterly, in my case, or it can be monthly, I think, investments, you are also buying the market lows. So you are buying these so-called dips, and that should be better than buying with a large amount, a lot of units at some point, and it might be at a certain peak in the market. We know that usually the shares market are growing anyway, but it's better if you are buying also when the things are not going that well, and you are basically, that's in your favor. They will present you with a list of unit values. So for these investment funds, you have units, you will get these units, and they will show you the evolution of the unit prices over very long periods of time. Hopefully, if they have some history. If not, if it's new, maybe they have some other funds which they can show to you as trying to convince you. The idea is that that's somehow confusing, and we will see why, because yeah, it's the daily evolution of the let's say of the unit price, and let's say that they are doing everything so that in order to keep you happy, they need to keep you a little bit ignorant. So, you know, you might have heard about ignorance is bliss, and they are doing so in order to show you not that many details and only what looks good and to keep you happy. Wait a minute, are you telling me that you are educating people in order to make them feel miserable? Well, if you put it this way, maybe I don't want to be the only one knowing all these things and feeling miserable. Somebody should join me. The exact performance in your portfolio will vary because you never know exactly how many of these dips you have bought. So when the market was down, and how many of the peaks when the market was very high you bought. And it's always better if you bought more dips and less peaks during the lifetime of your policy. And however, there are studies which show that instead of doing an investment at some point in the market, it's better if you buy with these regular investment plans, and somehow they deliver returns which are above the market indices. So for example, above the FTSE 100 for London Stock Exchange, or above the New York Stock Exchange indices, or the Nasdaq indices and things like this. The idea is that just as for the investment funds, just as for the insurance with the cash value, also for this one with unit-linked you need to pay for the middleman. If for the insurance with cash value the things were more clear, you knew that you had a premium which will get indexed with 3% every year, and you have the insured amount, and you will get a bonus at the end of 10%, and you will also get some of the profits which they are making from reinvesting the money which they are not using. Let's say that with the unit linked, and in my case the things are not that transparent, basically they could do this in two ways. They could draw their commissions from the value of the funds and then present to you with the value of the unit price, which is already reduced with their commissions. But that has the disadvantage for them that they will show you a reduced performance in the increase of value of the unit price. Or they are doing in another way, which I don't like, and this is unfortunately the way that I got, is that, okay, first they are commissioning your premiums, so you are not getting the units for the entire money which you are paying, you are getting the units for a reduced value. And then with each and every month they are withdrawing from your units a certain amount. I've calculated around 5 units for 3 months is in my case. The idea is that they can still come up with that prices list for the units, which increases, and it's not deflated with their commissions, and they are withdrawing their commissions from your number of units somehow from the back. And somehow this is difficult because you cannot assess the performance, the exact performance. They will say that, for example, for year 2020, the value of the unit has increased with 20%, but that doesn't exclude already the commissions. So it might actually be 15% if they took 5% around 5% the commissions. That being said, we go directly to the post-valuation. For this format, for this life insurance with unit-linked plan, there is no, or you can actually do a pre-valuation taking into consideration the price increases from the past or something like that, but it's not really feasible. What I can do is a post-valuation, or what happened up to date. I have the two policies, I bought them in the same time, so in my case the one with cash value is 14 years old, and the other one, the unit link, which I will just show you in 1 second, is also 14 years old. I'm showing here a graph which is showing you the indexation. So you see that the premium indexation was in the second year almost 7%, and then 9.4, it went down a little bit to 7.9, 8%, and it kind of stayed 8% till the 14th year. And that leads to the fact that you had the light green line, and with the dark green line you have basically you can have that materiality. You can see that okay, the premium which I have paid 14 years ago, now it's almost tripled. Yeah, so I paid 1 and then it started growing, and now I should pay 2.9 times what I have paid at the beginning. You probably remember this template. I have introduced it in the video about how to evaluate your investment. The link should be displayed right now to that video. The idea is that so many things are possible, and with this indexation you can have this indexation, you cannot have it, and inflation rates varies and so on and so forth, and they will show you this unit price performance, and in the end you will ask yourself, but what the hell am I doing? Really, is my investment going well or not? Is it worth staying locked in or not? And the beauty of this template is that it doesn't matter. You can have the system as complex as possible. You can see the amounts on the regular investments. Those are the premiums. I've paid 816, almost 817 in the first period. That would be the first quarter of the first year. Then I don't display here because this is going on 56 periods actually till current period. So in the 14th year, I have hidden the periods in which the premium stays the same, and then it's increasing. It's then 873.3, and it's reaching in period 49 a mesmerizing 2197.6. So for one quarter. And just as I have said, maybe in some periods you have skipped the premiums. I have skipped the premiums in the last 4 quarters. You see in the period 56 is the last quarter is 0 the premium. So you have all these specificities, you have this indexation, you have maybe premiums which you are skipping voluntarily or not. It doesn't really matter, and it's very hard to evaluate such an investment if it's doing well or not. On the positive cash flow one, you have this 129,840 is actually the value which the fund is, so the insurance company is showing for the units that I have in this fund. It's, in my case, it's one with a very high risk because yeah, I'm not that risk adverse. What I have kept from the other type of insurance, from the insurance with cash value template, is the discount factor. So that's the inflation rate, the quarterly inflation rate. As you can see, it evolves between, okay, it starts with 1.2, 2.0, 1.4. We are getting to somehow very low numbers at some point, 0.3% in the period 29. So in the year with period 29, but you also have deflation in the years with period 33 and 37. Long story short, cumulated, we have an inflation of 59.4, so almost 60% after 14 years, which is quite significant. And then we are discounting this. We have compounded the periodic discount factor into this compound discount factor. Then we are discounting the cash flow. Remember, the cash flows, total cash flows, are just the sum per column. It doesn't really matter. You see, I have only negatives one, except the current period where I have the value of my investment. And you discount it, and for example, the period 56 cash flow, which is plus this 129,840 discounted with this 59% is equals 81,444, which is relevant for bringing everything in the period 1. And then you just do the sum of all these discounted cash flows, so from period 1 to period 56 in my case, and you get to a net present value of 26,837. Since it's a positive value, that means that I have invested, or this investment is bringing me a gain above the inflation rate, which is of course positive. If you go the other way around and you say I want to see the value in the period 56, remember you need to compound this inflation factor, but you are going from right to left. That means that you need to take the value, for example, from period 1 and to multiply it, in this case, with 1.6 or 159.4%. The 816.8 will then become so minus 800 will become minus 1302, and you also add all the values, and you get to this 427,785.1, which is the current value of my investment, let's say, or I call it here the net future value. It's relative. If you are in the past, you are looking at the future. You are in the future, you are looking at the past, and things like this. So it's a good investment because, first of all, it's delivering a positive NPV. That's your take from this slide. The idea is that you can find out the exact internal return rate or the return on investment as a percentage. And you can see with how much I beat this inflation rate, this 56%, or 59% was it exactly? This 59% in 14 years, of course, there is an average yearly inflation rate. It's fluctuating, but an average exists also. And you can see how much was my total return for these 14 years and how much I got in an average year to beat that average inflation rate. But for that you need to take my course Credit and Investments. Remember, my courses are available on, and you have below this video links, are available on Udemy with the paper course scheme, on Patreon with the monthly subscription. You can gain access to all my courses, and also on LearnFly you can have access to, with a monthly subscription, to all the courses that they have on the platform. So that's also very beneficial. It depends what you are, if you are just targeting a specific course or you want to see what's out there and you want to learn more things, maybe a subscription is better for you. It depends. Then I told you that I have a coverage component, so a life insurance. It was at the beginning when I started with this 816 initial installment, so initial premium. It was 5,600, and of course it got indexed because also my installment is now almost 3 times more than that. If you remember the chart that I showed you, and it's now 15,177 due to indexing. However, this is what I was saying, that you can see the shift in weight. The risk covering component is so low, it's only 15,000, compared with the life insurance with cash value when the risk covering was for 249,000, which it's clearly a shift in focus. And for the investment component of that policy, we were getting a negative NPV. For this one, we are getting, of course, a positive NPV. And I'm also, that's what I'm saying, that I'm also, I have, actually there are 2 clauses. One is for inability of paying my premiums before the age of 65, so before the pension age, and one is for inability of paying my premiums after the age of 65. So that would be it for today, the presentation about how to invest in life insurance with unit link. Let's say that this looks more like an investment. The other type with the cash value that we spoke last time, it's let's say investing is a byproduct of covering your risks. How you can support me? Of course, you can like this video if you like it. You can comment if you have anything to add to the ideas and to the discussion. Also to share it with somebody that you might think might be interested about whatever I'm presenting in this kind of videos. And most importantly, please do not forget to hit the subscribe button and the bell notification. You will never miss a new episode once I'm releasing these videos. Right now I'm releasing them quite regularly, 3 times per week. One is Tuesday, the other one is Thursday and Sunday. Next time we will see each other with the same kind of asset class evaluation, and we will talk about the real estate. And let's say that from all of them, from all these investments that I intend to, from all these asset classes that I intend to present to you, that is the most complex of all, and you will see exactly why. Also below this video you have links. First of all, you can create an eToro account and trade there without commission or fees. No matter how often you are trading, not paying any commission or fees, it's a saving, so it's very beneficial. You also have 2 links for Amazon programs. One is for 2 free audibles if you like audibles. The other one is for joining the Kindle program if you like reading books on your Kindle, so electronic format books. And last but not least, there is a wish list from Amazon as well, where you have products or software and hardware products which can help me a lot to improve the quality of my videos. So it will also be very beneficial for you, I think, but it's also probably the most inconvenient. The easiest for you is to just hit the subscribe button and to keep watching my videos. On this wish list you have things like better webcam, a laptop, a light system for my apartment, a green screen, the latest version of Microsoft Office, the latest version of this video editing software that I'm using, and so much more, so many things that can help me really improve the quality of my videos. I hope you enjoyed the video today. My name is Alex Petrescu and I look forward to seeing you next time. Goodbye!